Hey folks, this is Don Graves. There's a paper, white paper I want you to download. It's about utilizing home equity to mitigate spike expense risk. Using home equity to mitigate spike expense risk. It was produced at the Conference of Consulting Actuaries, and Barry Sachs and his brother Stephen and just some other really smart folks were talking about spike expense. We know there'll be expenses in retirement, but they really focused on using home equity, housing wealth, reverse mortgages. This particularly was how do we overcome and mitigate that. Now, if you watched me before, there are primarily three buckets in retirement that most retirees have access to. Their income bucket: Social Security, pension if you're lucky, employment if you're working. The investment bucket: IRAs, 401k, brokerage account, a house in the Hamptons, a business to sell, and that's going to be taxable, tax-free or tax deferred. And finally, your insurance bucket: fixed and variable annuities and life insurance. Now, we've got to live off of these things for all of our life, and we've got to overcome some challenges that happen in retirement. This is what the article, that now the spike expense is when all these things happen all at once. It's like over the winter, my circulator pump went in my furnace, and then the roof water came, 10,000 gallons came down, and then my bedroom ceiling was leaking because there was ice that had built up upon there. So spike expense are things that come all at one time, and now you've got to choose which bucket to kind of draw from, and that can really offset some of the things you're trying to accomplish in retirement. Now, the good news is that 87% of retirees in America have a fourth bucket: housing wealth. So the reverse mortgage allows them to convert a portion of their home value turned into tax-free dollars based on three things. This is an ugly triangle, but age of the youngest borrower, number two, value of the home, and number three, future expected interest rates, called expected interest rates. So here's a 68-year-old couple and a $650,000 home, and notice their reverse mortgage line of credit is a GLOC, a growing line of credit, $216,000 here. Now notice that the reverse mortgage line of credit is a growing line of credit. So when we get down here 80, 90, 30 years later, what's happened? Well, now we've got access to 800, a million, $1.8 million. So when we're looking at a retiree's total retirement income package, does it make sense, in addition to their income, investments, and insurances, to talk about the fourth bucket, which is housing wealth? Well, I tell you what, I think that makes a lot of sense to consider that. So again, the full article, you can download it. It's their work. I just made it available to you, but it's an excellent resource to have as you're beginning to build, becoming a comprehensive, or expanding on being a comprehensive, holistic retirement income planner. Involves incorporating housing wealth in ways that you may have never considered before. All right, this is Don Graves. I'll talk to you later. How do I turn this thing off?